Okay, folks, I just returned from a well-deserved break, my first vacation in over 2 years, from San Francisco to the Rocky Mountains of Canada. Not really focused on the market as my portfolio has been correcting pretty dramatically. I'm now sitting on a combined portfolio value of around $350,000, but over that vacation, I was still buying stocks. We're going to talk about the stocks I bought, the stocks I'm continuing to buy, and stocks that I think I would put on my buy list while we analyze the US and Canadian economy as recent data has kind of come up, giving me some new bullish sentiment. There's going to be a lot in this video as I haven't updated you in over 2 weeks, and if that is a conversation you can appreciate, in return, I simply ask that you hit that like button, folks. But first and foremost, just taking a look at where the market sits since I've returned from my vacation, and God, I'm glad I took one, because the market, the S&P 500 hit new recent lows, now down 23.84%. The NASDAQ is down 32%, and the TSX, the S&P TSX, the Canadian side of the economy here, is down 12.35%. And I want to fixate a little more on the TSX because there's a lot of bullish sentiment coming out of Bank of America, but we'll come back around to that later in this video. But just diving into the portfolio itself here, folks, let me minimize my face so you guys can see the whole overview. Total portfolio value is sitting at around $323,813, correcting pretty dramatically on the combined portfolio, down 7.3% or $25,000 here, folks. But before we talk about the stocks I have been buying, I want to talk about the cash position itself, because recently my corporate taxes have finally come due. My accountant has finalized what I owe the government, which luckily in Canada, the corporate tax rate was 11%. So I made some good money last year, didn't end up paying a huge amount in taxes. But the thing about the cash position is the only place I've actually seen some capital gains. And what I'm talking about is the US to Canadian CAD, the Canadian currency conversion, because I was putting all of my tax money over the last year and a half in US dollars. I had over 20,000 in USD, which I just converted about 15,000 of it. And taking a look, guys, I mean, just year to date alone, the US dollar to Canadian dollar is up about 10%. So I made almost a 10% gain, give or take, depending on when I was converting or when I was collecting that USD. But that 10% gain is literally the only place I've seen like actual capital value. So I've converted 15,000 to not only pay taxes, but just to balance out my accounts. Because if I scroll down here, just to show you guys the cash position and how it's divvied up, I have just about 15,000 between my regular accounts. So from high interest savings and my regular savings, sitting about 15,000, and I have a little bit USD in my regular accounts, and then the corporate accounts, I'm now sitting on about 10,000 CAD after paying all of my taxes and all the fees that come with that. And then I'm still leaving about $5,000 in USD because I still want to have exposure to the US dollar, but not nearly as much because obviously I'm operating in the Canadian dollar of things. But I did take some of that USD and I invested it. We're going to talk about those stocks and the Canadian stocks that I recently bought because I continue to add to my index funds. But first and foremost, before we talk about that, since the recent purchases, guys, my annual dividends now sit at $9,779, which is beautiful passive income because the vast majority of it is coming from indexes, which is yielding me just over 3% as it sits today, with some really juicy dividends coming in for September. I made over $1,000, nothing better than that, going on vacation and coming back with some really nice cash building up in the account, some reinvested dividends. I had some dividends come in from SCHD, some of my US dividend ETFs like VYM, and those purchased some more shares, which was really nice. And we'll come back and talk about the overview in a second, but we'll take a look at the stocks that I purchased. But I want to shout out as well, while I was on vacation, some of you have been purchasing my portfolio tracker here, which, if you are a Canadian investor trying to convert Forex, I've done a fabulous job basically at making it so all my US and Canadian stocks all convert to the Canadian dollar. And I do have a Canadian focused and US focused spreadsheet for those of you US guys out there watching, or those Canadian guys that just want to buy Canadian stocks. So if you want to support the channel, go to the portfoliospreadsheet.com. You can buy the tracker, guys, and I'm going to be updating it. You get all the free updates moving forward. So bear with me because there are a few things that I will be fixing within the tracker itself. And I've extended the discount through October while I work on fixing some of the errors that I have been running into, but they are easy fixes, just some little things here and there. But first and foremost, guys, I have been buying the S&P 500's VOO. I did buy another $2,000 worth of this while I was on vacation because my corporate accountant actually called me when I was sitting up on top of these ice glaciers, the only place I had cell service, and really weird doing taxes on a mountain. But nonetheless, we did finalize that. So once that kind of came through, I realized I had some extra cash to invest, and I bought a bunch more of VOO. VOO, which currently, if you don't know, I always recommend coming into the Vanguard actual, their website where they can show you what the holdings are, because these have actually been changing out pretty dramatically on the lower half of the top 10. I mean, ExxonMobil now is in the top 10 S&P 500 stocks next to J&J and United Health. It's really neat to see in these volatile markets what's actually been updating and changing within the top 10 holdings here, which again is why this is so beautifully passive, because for those of you that don't know, basically Vanguard's products here, they weight stocks by market cap. So as the market caps have been changing so dramatically, because you got to remember Facebook was once sitting, I think, around the top 5, and it doesn't even exist up here anymore, which we'll talk about Facebook in a second. But it's nice that basically based off how much a stock is moving, it'll lower weight it, kind of getting rid of some of the volatility risk, because you don't want to be holding Facebook that drops 50% and keeping it at a same weighted position. So it's really nice how VOO works. I'll continue to state that as I move forward, because I think it's one of the most passive ETFs you can buy. I did buy a lot more of the Vanguard Canadian High Dividend Yield Index, which actually I just purchased more today, and I really want to talk about this ETF specifically in a second, because I think it's going to be one of the greatest buys into the ending of 2022 and into 2023. And just taking a look, this one doesn't adjust as much because the Canadian stocks have all been kind of falling in tandem here with Royal Bank, Toronto Dominion Bank, you got Enbridge, Bell, all of these great companies that I still love to buy, not only individually, but I think this ETF does a good job at bringing them all together. But again, I did buy more of the Schwab US Dividend Equity ETF, but that was more on a drip, as I told you before I went on vacation. I did set up all of my stocks on a drip so they would reinvest automatically, making it even more passive. I'm trying to build the most passive, safest longevity portfolio as possible. So I went ahead and I did buy more. I bought more VYM as well, which is another Vanguard High Dividend Yield ETF, guys. And these things have actually, all three of these stocks, so VDY, SCHD, and VYM have all been outperforming not only the S&P 500, but the NASDAQ. So this has been a place of solidarity and just a place of security for me while I can collect really great dividends that I don't have to focus on the companies nearly as heavily. But I want to talk about individual stocks in a second, because I might be adding some focus and looking at buying some individual stocks, because there's some crazy huge discounted deals if you're looking for really high yields from incredibly secure companies. But first and foremost, guys, there's been a lot of big news here, and we're going to talk about the jobs report. But I found this interesting article that says 7 reasons Bank of America thinks the TSX will outperform the S&P 500. And the vast majority of the top weighted TSX companies sit in that ETF VDY. But I was just skimming through this, and I found it really intriguing, because Canada is mainly a commodities focused industry. I mean, we have real estate, we have our banks, and we're really heavily oil focused, gold. Like, we just have a lot of commodities, right? But it's not all about oil, but crude doesn't hurt. So as most people are aware, crude has been bouncing back actually as of recent. If I can pull this up real quick, you can take a look at some of the commodities. I don't know what crude's going to do. There's been a lot of speculation about countries coming together to basically short supply crude again, driving the price back up. But I think there's going to be a lot of continued volatility. But I hope this finds a baseline, and this is just an interim bounce, because we cannot have oil skyrocketing again, as it would just drive inflation out of control. Nobody really knows what's going to happen. But even if oil can just find a baseline around here between $80 and $100 a barrel, I still think we're going to start seeing the ending of inflation itself. But most commodities have still been all over the place. Gold, silver have been rebounding a bit. A lot of the other commodities are still holding down. They're not bouncing as heavily as crude, but that's just one aspect. Now, cash is king. The TSX is flush with cash. With rising rates eating into savings, Bank of America noted the TSX Composite appears to be in a better yield play than the S&P 500, offering investors steady payouts that exceed those from its American counterparts. Now, the big problem with this is that they make it sound like it's an intriguing investment for U.S. investors. And though I think everyone should have a globalized portfolio, Canadians have really been getting the benefit here, because not only have we been getting these incredible higher yields, but we're not dealing with the currency conversion. Because if you're in the US buying Canadian stocks, you have to be aware that those Canadian stocks you're buying in Canadian dollars, you've just lost a huge amount of value, because if you convert it back to USD, you've lost 10%. So you're seeing a much larger correction than us Canadians that have been buying US stocks. And even though the US market is down, we're buying them in US dollars. So if we sell those and convert them back to CAD, we're still going to see a really huge gain if we've been buying it since the beginning of the year, even though our US stocks are down. But nonetheless, that too, the bank's eye shouldn't be supportive to valuations over the long term, particularly if rates remain at this elevated level for some time. So we're in an economy where things can actually kind of be a little bit better from, like, not only that, but an earnings perspective as well, because recession risk is already priced into the TSX according to Bank of America, with recession seeming more and more likely when rather than if. I think we're in a recession. I don't know how this article is missing some stuff. As the path of a soft landing narrows, Bank of America says the valuation of the TSX has essentially priced in such a pullback in economic growth, while the U.S. markets have not. And I think that is largely true because our bank valuations, I mean, you look at the valuations of the top holdings in the S&P 500, Apple, Microsoft, they trade at real big premiums. I think the PE ratio sits right around 19 right now, whereas with the TSX, I mean, most of the Canadian banks are around at a 10 PE or lower right now. But you got TSX earnings appear resilient because, again, we're dealing with a lot more oil and commodity companies that have benefited greatly. And just kind of scrolling down, guys, another big thing is Canada's advantage amid the geopolitical risk. We're not really exposed to the Russia-Ukraine crisis as much as the US has been to some variable rates. But not only that, guys, another interesting fact of the economy is that the US jobs reports came out along with the Canadian jobs reports. And this was really intriguing because US jobs rose while unemployment dropped. So we're still seeing better than expected job growth, not only in the US, but the Canadian side of the border as well, as Canada added 21,000 new jobs, which again was better than expected. So it's variably a weird market when we're still seeing a recessionary period where we know companies are slowing down. But as mentioned, you can't take Shopify and tech companies doing layoffs and slowdowns is the entire economy when we're talking about job hirings, because there's been a lot of jobs for the commodities market, few other aspects of the economy that have been hiring still. So we're seeing this kind of balancing out between the different sectors of the market, still showing some resilience. And again, this is going to tell the Fed that, hey, if we have to continue to raise interest rates, we could do so pretty greatly. But I'm going to talk more about that in a later video, just because, there's a lot of details that come into trying to predict the economic circumstance of this really weird recession we're in, and if the Fed's going to continue raising interest rates, and hopefully inflation, as I'm predicting, will start to roll off rather dramatically, probably toward the later half of this year. But as we head into October, guys, you got to start paying attention to earnings. And if there's some earnings that I'm going to be really fixated on the US side of the border, guys, Apple, a lot of conspiracies around Apple again, and perhaps slowdowns and the issues with iPhone sales. Apple's now down 22.94%. I wonder if Berkshire's back into buying it because they were buying back in the May dips. So I don't know. It's going to be neat to see if Apple, rolls off. That's going to be very bad for the general S&P 500, probably hurt my VOO position. Facebook is one that I'm highly fixated on because this thing continues to find new lows, now down 60% this year. And I think we're just starting to see the biggest discounts in some of these US tech stocks than we've ever seen. And I really think, guys, it could drop more always, but when we're talking about a PE of 11, and I really hope Facebook, they're slowing down on the VR stuff, which I'm obsessed with, but they're supposed to release their new VR in October here, which I will be buying when it drops. I really want to get my hands on their new VR technology, as I've still been religiously using the Oculus. So it's going to be neat to see how they continue the VR push, but this thing has continued to have incredible negativity behind it, which I think at this point doesn't do it justice. This company, maybe I'm going to be buying back into it. I'm looking at some tech companies as soon as I feel like interest rates are done peaking. But outside of that, guys, from a dividend investing perspective, and again, I will be talking a lot more about tech stocks with Tesla and a lot of these other companies coming up. A lot of crazy news in Toronto here. They just started releasing self-driving food trucks that are going to be doing deliveries between food stores, which is just fascinating to me. But I'm looking at some of these resilient Canadian stocks that I sold off at the beginning, toward the second quarter of this year, as I kind of consolidated into VDY and just buying index funds. But TELUS Corporation, guys, I mean, take a look at this thing. I think the PE is a little high, but it is just because it's now almost paying a dividend yield of 5%. And this thing continues to have really resilient earnings. The earnings haven't really dropped off dramatically, and I still think that comes to the fact that Canada is based off monopolies. We only have 3 to 5 major companies in every sector, whether it's banks, telecom, even these commodity stocks with things like Enbridge. And they continue to take advantage of our growing population and immigration. And if you come in as a new person or just somebody that's immigrating to Canada, you really don't have a lot of options in your telecom providers, right? You have Rogers, you have Bell, you have TELUS, and there's just no real big majors outside of that. So these things I think are going to continue to do well. And as those yields approach 5%, I'm very intrigued. Now, from energy perspective, Enbridge has been doing very well this year, but the yield is now approaching 7% again, which is wild to me. And another really neat one that I own that I'm thinking about buying back is Northland Power. This one I sold off right when it started to rally, which kind of broke my heart. Again, consolidating into VDY, but now this thing is yielding back over 3%. This is one of the largest, I think it's the third largest natural energy producer from wind and solar globally. Beautiful company here. Was literally one of the first stocks I ever bought. Kind of sad that I sold it, right? But I am thinking about perhaps buying back into some of these, utility companies, because they've just been so resilient with things like Algonquin Power, though I've been selling off. The earnings have been really good, and it's consistent yield if you're looking for passive income. And in the banks, as mentioned, guys, the banks make up the huge part of our index fund, the TSX S&P, and this is why they're saying there's better value in the Canadian economy, and why Bank of America thinks this is a safe haven for a lot of investors, because the yields are absurd, and most of these banks don't have a payout higher than 50%, and their PEs are now back to ridiculously low levels. I mean, CM is at 8. I mean, Bank of Nova Scotia is at a PE of 7 with almost a 6.4% yield. And even in the US, right, look at JP Morgan's sitting at around a PE of 8 with a 3.78% yield. Now, again, guys, I can't talk about everything I want to talk about in this video, because since I've been gone, there's been an onslaught of news from a bunch of companies that I absolutely love. So perhaps what I'm going to do is a live stream in this coming weekend, and we can sit down, have further discussions. But I will be making a lot more videos, and I will pass the question off to you at this point. What have you been doing with the broader of your portfolio? Like I said, I'm continuing to cost average into my ETFs. I think we're sitting in a discounted territory, though the S&P 500 may be overvalued. I just can't foresee why, come 2023, 2024, that we're not going to see higher periods in the market than we're experiencing now, and that's purely speculative. But like I said, I'm always going to be buying, always going to be trying to jack my yields, and I want to get over $10,000 coming from very resilient ETFs. Nothing gets more passive than that. But let me know what you guys think in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.